Great, so welcome, good morning. My name's McLoughlin and I am Head of Wealth Management at TCM Wealth Management. It's a partnership practice of St James's Place. Myself personally, I'm a Chartered Financial Planner. I'm a Fellow of the Chartered Insurance Institute and an affiliate member of the Society for Trust and Estate Practitioners. I've spent most of my career between offshore in the Channel Islands and in central London in many private banks. So the clicker works. There we go. Today I'm talking about an investment philosophy that works for you as clients, and talking a little bit about how you can create an investment philosophy using the investment management approach of St James's Place and the exclusive retail funds that you can give clients access to. So I'll be speaking about those funds a little bit at the sort of back end of the presentation. So I think really today, let's have a look. Yeah, so today I'm really talking about, I think a lot of you have come today to really understand how a lot of the companies here can help you start to sort of self-invest, or more the boutique end of investment planning. I think what I'd like to try to do today is really talk a little bit about, before you embark on that journey to self-investment, how you can create a steady and firm platform and strategy for achieving that with mitigating the risk. I think I'm going to talk about not only what you should be doing in terms of picking the winners of maybe tomorrow, but how those winners might sit within a strategy. We can talk about how that strategy might allow you to have flexibility over your planning, not only in the short term, but also the medium and long term, and how you might be able to adapt that plan with minimizing any costs of entering or exiting any strategy you encounter. Once I've done that, I'm going to explain a little bit about how you go about then picking the right investments to pick within that strategy, and how you might be able to leverage, as I said, the exclusive funds that St James's Place can give you access to. So picking the right team. I think an important question to ask yourself as clients: how many of your advisors or brokers that are recommending a stock or fund to you have an intricate understanding of your objectives, your financial situation, and how that might change over the short, medium and long term? And I suppose, how many of the advisors you have at this point in time, how many of you do you get a second opinion with, to check that the advice you're getting is fit for purpose, and that the products that underpin those solutions and strategies are representing the best value that you can get in the market? Now, too often we find that clients are not getting the most optimum advice, or that the products and solutions that underpin them aren't giving the best value for money. Now, we set up TCM Wealth Management Limited in Mayfair in London with the principle of capital excellence. Now, we only hold advisors that are chartered status or higher, to ensure that our clients can be confident they're getting the best advice. And we chose to partner ourselves with St James's Place to ensure that they're getting access to the very best products that underpin that. So St James's Place is an award-winning practice, and I'll tell you a little bit more about that. They're a FTSE limited company, currently with nearly 60 billion of funds under management, and founded in 1991. Now, I'd like to show this slide because it shows the funds under management at St James's Place over the last 10 years. Funds under management have grown by 18% per year compounded. And I like to think the only reason this can happen is because we're an attractive proposition to clients. We can attract clients with a strong investment performance mandate, but also retain those funds over the long term. Because once a client joins us and understands that investment philosophy, they realise and appreciate the value of what they're getting access to. The great benefit of joining St James's Place is that we can give the look and feel of a very small family office approach for our clients. We get to know them and understand them, but what sits behind us is a FTSE listed organisation that guarantees the suitability of the advice that comes out of our practice. What they're doing is they're guaranteeing that the suitability of the products we recommend, the solutions, the tax planning we do for clients is the right planning for them. Very few organisations will sit behind a client and say what they're recommending is the right thing for their client's circumstances, not only now in the short term, but also in the long term. Now, my job as a client is to find the best products and solutions. And St James's Place does that for our clients. They've won a number of awards over the few years. Some of those awards have been the Investment and Wealth Management Awards this year in 2014, and the City of London Wealth Management Awards 2015. And we can demonstrate that going back over the last 5 years, a number of accolades that we've won. Now, I suppose for all the nuances that St. James's Place give us for our clients, all the unique products, the innovative solutions that we can recommend, we still fundamentally believe in a face-to-face relationship with our clients, getting to know you individually, getting to know your financial circumstances and objectives for the future, so we can best pick those products and solutions to match your requirements for the future. Now, we hope we've got the right team of expert advisors with a track record of performance, the right kind of qualifications being chartered or higher. We think we've got the right solutions and strategies through partnering ourselves with St. James's Place Wealth Management, one of the largest now UK wealth management organisations in the UK. They're guaranteeing the advice for our clients. So now we need to set out and pursue the right investment strategy. So how do we go about doing that? Now, our circumstances change. Our aims and objectives for the next year are highly likely to be quite different from what they might be in 5, 10 or 20 years' time. We want to ensure that any strategy we put in place for our clients maximises not only the products and solutions available in the UK and offshore markets, but also they're utilising their full tax allowances, so income tax, capital gains tax, their spousal allowances, maybe their child's allowances, but more importantly, that they have flexibility for that plan to adapt to any change in their circumstances, any risk that might be incurred. That they won't have to incur costs going into a strategy, only to pay those costs to come out and change that strategy to change that going forward in the future. So before I start talking about strategy with clients, and I suppose a lot of individuals here might be self-investors, I start to ask questions, well, how truly are you aware of all the options available to you in the market? I firmly believe in you don't know what you don't know. Constantly striving to learn more, do more exams outside of my specialism. Quite frankly, so I've exhausted them in my own. But because actually that incremental knowledge can change the way we might invest. You as investors might ask yourself, well, do you understand how to utilise things such as enterprise investment schemes and venture capital trusts, now a maturing market, to utilise and have flexibility over how you pay tax, how you might defer that in tax planning strategies? You might ask yourself, I suppose, do you have a strategy that is fully tax efficient? Do you have one that incorporates any of the challenges we might face as we progress into the later years of how we might want to pass that wealth on down the generation and not incur too much inheritance tax planning? Always one. I suppose for me, for clients, it's about making sure you're getting the right advice. We've seen lots of financial legislative change over the last few years. Pension legislation changed this year. We've had the new inheritance tax thresholds changing with the new principal residence allowance and the new dividend tax allowance that's coming into effect next year as well. Are you getting advice from your advisors on how your strategy should incorporate these changes or how it might be adapted to any financial changes? These are important considerations to get advice from a financial planner before you start self-investing. So an investment management approach, how do you clients, as you the clients then, set about deciding how much you're going to invest and what you're going to invest in? The modern world of asset allocation is heavily dependent on statistical analysis. And I suppose, crucially, that's based on using past performance as a measure to gauge what you might expect to get in the future. I think dangerously, however, though, these models predict that what hasn't happened in the past can't happen in the future. And sadly, we know this not to be the case. We've seen the Lehman Brothers crash, we've seen 9/11, and I suppose recently the Chinese slowdown. I suppose at St. James's Place and TCM Wealth Management, we take a much more fundamental and sensible approach to investment management with our clients. And I'd like to talk through that in a bit more detail. We use 5 key golden rules to investing that were popularised by Sir Mike Weinberg, who founded St. James's Place a little over 20 years ago. Now, the first 4 rules are highly subjective and they depended on your individual circumstances and is where we need tailored financial advice. Rule 1 is about holding enough cash to cover short-term needs. What we want to ensure is you as a client that you don't overexpose yourself in the investment market. So you have to then tap into any investment strategy and come out of that because you're going to pay fees, advisor fees in doing so. So we want to make sure what is the right level of short-term cash requirements for you. I suppose equally we don't want to be holding too much because it's going to undermine our investment strategy for you. Rule 2 is about being aware of the damaging effects of inflation. I think too readily in the press we get quoted that inflation's dropping, and I think at the moment it's around 0.1%. I can tell you that a much more subjective analysis of inflation to your personal circumstances will give you a more robust understanding of how you should be investing. I certainly know that my rail fare is increasing by more than 0.1% per year. Rule 3 is about investing for the long term, and we'll talk about why that's important and diversifying that through Rule 4. Now, Rule 5 is about selecting the right fund managers, and that's where I suppose we get the value of St. James's Place as the investment managers behind the wheel driving your long-term performance. So we've talked about this already. It's about holding enough cash for your short-term needs. You as investors could fall potentially into the trap of over-leveraging yourself in the markets, and I too readily see this, where people come in and out of positions to fund short-term liquidity. We want to ensure that if markets were to fall in the short term, that you have enough time and capacity to ride those out. Rule number 2, I've talked about inflation. If we have a more detailed understanding of what your personal rate of inflation is, what your views on interest rates are, and actually what type of growth you need to achieve your objectives, we can have a much more robust understanding of how you should be investing. If we don't take this into consideration, and we're just blindly aiming for growth without netting it down for the effects of inflation, there's a risk you might not achieve your objectives, or you might take too much risk than's required. Rule 3 is about investing for the long term. Now, what does long term mean to you as investors? It might mean, I suppose, investing for a nest egg. It might mean paying off the mortgage if you're lucky enough to own such a lovely house. It might be just having peace of mind and comfort that whatever happens in the future, you can then flex your situation to adapt to that. Rule 4 might be, I suppose, it might even be just having a comfortable retirement. When we look what your objectives are and we start to talk about how important those objectives are to you and start to have a detailed conversation of risk, we then have a much more confident understanding of how you should be investing. And if you're not sitting down and having that conversation in relation to your objectives, as I said, we end up taking potentially too much risk with those strategies, or we have unrealistic aims and aspirations for what we might achieve. Now, if I ask my clients if they only had to take a certain level of risk to achieve their financial objectives, would they take any more risk than necessary? Would they try to achieve increased levels of growth by taking more risk if it meant simply they might not achieve those objectives? The answer is normally they wouldn't. So what we want to try to do as financial advisors is to tailor that advice to your circumstances, to make sure that you have the right strategy in place. And we would like to sit down and work with you to understand how that fits with you. It's critical that investment strategy takes those unique circumstances into consideration. So is now the right time to invest? I suppose Mark Twain said that September is a peculiarly dangerous month to speculate in stocks. He also said that others were July, January, April, etc. The point is that no one really knows. And if we're investing for the long term in our objectives, why should it matter? Why should it matter with short-term movements over the 12-month period if we're investing for that long-term objective for you? If we hold on to a well-diversified portfolio of shares for the next 10, 15 or 20 years, based on past performance, we're far more likely to be richer and better off than we are today. For us as investment managers, it's about time in the market and not timing. I suppose the flip side of that is the moment, I suppose, we're 15 to 20% off a lot of the highs in the current market, so it might be a good time on both the time front as well as timing, I suppose, to consider long-term investment. This graph shows us the importance of long-term investing, and what it's showing us is different asset classes of equities, bonds, and property over time, and how major crashes affect the long-term performance of those. And what we can start to appreciate is that if we look at periods such as the dot-com peak, that given time, asset classes do recover above the previous high that they were exposed to. That can be said the same for the subprime mortgage. It can be said the same for the European debt crisis in 2010. So if we give ourselves that long-term objective, we're far more likely to see greater levels of growth and see positive performance. The flip side of that is short-term investing does give you very incremental levels of volatility. And that's why Rule 4 is important. Investing for the long term gives us some element of protection, but diversification can give us a truly reduced risk profile for our clients. It can reduce volatility, give us more stable and consistent returns that enable us to plan for your long-term objectives. This graph shows the power of diversification, and what we're looking at is each colour represents a different asset class, and we're ranking those asset classes in performance over different calendar years. What this is demonstrating is no one asset class is king. No one asset class has been the top performing asset class over each consistent year. So by diversifying as clients, what this is enabling you to do is get more consistent returns and ensure that you're not exposed too heavily to one asset class that might see heavy volatility, such as, I suppose, Far East equities back in 2011 of 18% drops. It's real investment principles. It's about the principle of having a strong foundation for your investment management strategy. One share can be highly volatile with lots of ups and downs. But if we look at a multi-manager approach or a pooled fund, we know that that's not going to shoot the lights out in terms of investment performance, but we know potentially what that's going to give us in terms of investment return. Once we start to achieve our objectives, they start to seem feasible, we can then start to diversify into more interesting areas of investment management, more interesting areas where they have a higher risk-return correlation. The first 4 rules are my job as a financial advisor. It's about sitting down with clients and providing highly technical and specialised financial advice to your circumstances. Rule 5 is where I leverage the benefits of St. James's Place to go out there and select the right fund managers to underpin and drive the wheel of your investment performance. So let's talk about that investment management approach of St. James's Place, because it's probably one of the biggest selling points of it as an institution. Now, it's centred on an investment committee that sits within St. James's Place, and they're supported by an independent board of executives, and also an internationally renowned consultancy company called Stanford Associates. Their job is to go out into the market globally and identify the very best managers to sit behind the investment wheel for our clients. The overall position might be perceived to be complex, but it's built on 3 simple principles. And that's to select, monitor, and change. What we want to be able to do is go out there and select the very best fund managers from the world. We then want to be able to monitor those fund managers rigorously. And if suitable, I suppose, change them to put your money in the more capable hands of a different manager. Now, Stanford Associates is probably the jewel in the crown. Now, they're independent to St. James's Place, and their job is to go around globally and identify talent. They've got access to the whole of the market. They use qualitative and quantitative analysis. So they're sitting down with these managers and interviewing. And I'll talk a little bit more in the sort of the extremes they go to make sure they're getting the performance. And their primary aim is to focus on outperformance. I think a stark reality at this point in time is most fund managers, and I think the statistics are sometimes greater than 70% of fund managers in the market, fail to outperform the benchmark they track after charge to the clients. Stanford Associates is identifying those 30% that are going to give our clients the best ability to get long-term performance and achieve greater levels of growth net of charges. So talented investment managers are not isolated to the UK and US. Typically as clients, that's all you get access to through advisors. Now, finding the right talent is the job of the investment management team at St. James's Place and Stanford Associates. Now, the investment industry is exceptionally vibrant. Many managers typically move multiple times over their career from company to company. Very few will have a 5-year track record, for example, behind the same investment mandate with the same company. What does that mean to you as investors if you're going to put your money into a company only for that manager to leave? We compare this sometimes to, I suppose, the professional football industry, with the top talented players moving regularly from club to club. We don't focus, therefore, at the manager level or the fund management house. We want to go out and find the fund managers themselves, the individual talent on a global perspective, to see whether they can replicate their performance with our own internal investment mandates at St. James's Place. It then gives us the control to dictate who manages your money, and if they were to leave, and I'll tell a little bit about Neil Woodford leaving Invesco Perpetual last year, how can we adapt quite quickly to those circumstances and changes whilst minimising any charges on you? Now, our investment committee, supported by Stanford Associates, has identified 33 funds from around the globe that we think are the best performing managers and the best likely to achieve long-term performance. They're spread over 30 fund houses over 14 different cities. Now, one of the best benefits of St. James's Place is they've got nearly 60 billion in funds under management. So they're able to go into fund houses or managers and get access to that talent where other smaller firms wouldn't be able to. Now, we've identified 14 funds from around the world that we think are top performing and you couldn't get access to anywhere else in the globe. And it's because we've got the wholesale purchasing power of those 60 billion in funds under management. Now, if you think about that as a client, Stanford Associates is completely independent. They advise a few other firms in the world. And they're turning around to St. James's Place and saying, well, these 33 funds are the best funds in the market. You need to get access to those few clients. St. James's Place then has been able to leverage that and get access to nearly half of those that you wouldn't be able to get access to anywhere else in the world. That is our commitment to clients. So our commitment is to give them access to the very best talent in the world and change it where necessary to give you long-term fund performance. And to give that from around the globe, be that BlackRock, Invesco Perpetual, or Neil Woodford himself managing our own funds. The next thing is really to monitor that talent. Now, this is the biggest challenge, the biggest challenge as an investor. How do you monitor the investment managers you put into place and change them before they're likely to not get the great performance that you're expecting? Too typically the case is we only look to change when it's already too late. Now, our investment committee is committed to monitoring those managers on an ongoing basis. Now, in conjunction with frequent visits to the managers themselves, email conversations, telephone conversations, and detailed analysis of their performance, they put a premium on face-to-face interaction with those managers. Now, frequently throughout the year, Stanford Associates and the Investment Committee will sit down with these managers. They will ask them robust questions, the type of questions that you as clients would want to be answered. They're going to challenge them on their views of the market, challenge them on their views of what they think the markets might do in the future and see whether that is suitable for our clients. They even get a behavioural psychologist to sit down with these managers to test how confident they are in their views and how likely they are to achieve long-term performance. You need to ask yourself as an investor, how many places can you go to which have such a detailed and robust understanding of the managers they're recommending to put behind the wheel of your investment? How confident can you be that you're going to be able to monitor your investments on an ongoing basis to make sure they're going to achieve long-term performance? The last challenge is really to change, and to change appropriately. Now, because St. James's Place Wealth Management holds the underlying fund and are getting these talented managers to come in and manage that fund for them, if we don't feel they're confident or capable to continue that, all we do is we exit that mandate and hire in someone that goes from a good mandate to an exceptionally better one for them. There's no cost of entry and exit for clients there, so we can do that quite smoothly. So the benefits of the approach is we have no in-house managers, so there's no conflict of interest. We're not a large bank that's going to be recommending our own funds because we want the funds under management. We're going to benefit from that investment committee and expertise. Global research capability. To frequently ask your advisors, can they access the global market for you? Typically, they're going to be looking at just UK funds. I said a great example of this was Neil Woodford. So Neil Woodford did manage a proportion of our clients' money. And when he decided to leave in April last year, it took almost a year for him to set up the Neil Woodford Fund. So clients were left with a decision in that year period. Did they cash out and wait for a year and lose out on the market's performance? Did they stay with Invesco Perpetual with a team that was built on one investor? Did they incur all the costs involved of getting out and getting back in again? And as I said, all we did was turn around to Invesco Perpetual and say, okay, we're no longer happy for you to manage that mandate because Neil Woodford was the talent. We'll approach Neil Woodford directly and get him to manage that mandate from day one. So our clients saw no costs, no charges. To be fair, if they didn't even read the press, they would have saw no changes. And that's the ability that we have with our clients' money, that we can constantly monitor and change those managers for them. What happens if a talented manager was to retire? Would you know about it? We would. We're doing that research for you. So I suppose in summary, our approach and philosophy to investment management is a two-pronged approach. It's about giving you the best access to top quality advisors through our firm TCM Wealth Management. And we've got our main offices in London, in Mayfair. We've got offices around London as well. But also to make sure when we recommend a solution to underpin that advice, you're getting access to the very best products in the market. I suppose next steps, we think we've got the right team, the ability to create the right strategy, and the ability to give you the right investment. We believe it's fundamentally important to build up effective relationships with yourselves by sitting down with you face to face as many times as it takes to shape that investment strategy before you look to incur any fees. So you'll be able to judge the value that will be imposed by that plan before you start paying those professional advisor fees. And we think this is important to demonstrate value. We would like to come out to meet you in person or for you to come into our offices so we can sit down and have a conversation around your circumstances to see whether we can be improving on what you're doing at the moment. Equally, we're quite happy to come out to you in person at your home address. There will be individuals outside, hopefully, that can take down your interest if you want to have a follow-up conversation. We've got a stand over stand 13. Hopefully it won't be unlucky for us today. But please do come and see us, and thanks for your time today. I'll be outside taking questions if you've got any after today's meeting. I think we've got 1 minute, so probably got one question if that's okay.
How much is the fee?
So I can show you the fees from outside. So you're going to get whatever product we recommend will vary. So what we've done is done some independent analysis with a large accounting firm called Grant Thornton. And they've gone in and looked at the biggest 20 financial advisory companies and said, well, how do those charges look if a client invested £100,000 over 10 years with a 5% assumed growth rate? Now, you've got professional advisor fees, the advice I'm going to recommend, and then we're going to recommend a product to underpin that. So there's two types of charges, product and advice. We put those together. We came out around 2.3% per year over that 10-year period. That's very favourable compared to the analysis we've been done. So we're not the cheapest, but we're in the top sort of 5 in terms of value for money. And I suppose for that value, for that 2.3%, you're getting access to this investment philosophy, which we think distinguishes ourselves quite drastically from what other competitors can offer.
So the 2.3% does cover the...
So that would be all total charges, so advice and the products.
So the internal...
Yes, yes. So if we had 10% net growth, we're looking at 7.3%. That's wrong. That's not right, is it? It's not right. 7.7%. Yeah, of growth. Yeah, so I can go through all the portfolios. We've got an integrated app and go through all the performances of all the portfolios, and those show everything net of charges. And we're very proud of those as well. So please do come grab us at our stand, and I'll be able to talk through those. But what I'm saying is I think we represent very, very good value for money in terms of what we're offering in terms of the investment philosophy for our clients.
So basically, the way it works is the assets are with your company or they are with the other...
Yeah, so they are invested in St. James's Place, they hold a fund, and then we're getting those expertise to come in and invest a certain proportion of that within St. James's Place. So we're not buying into someone else's fund. We hold the underlying asset. Yep. Yep. Grab you after. I'll be outside if that's okay. I suppose last parting comment is we are far greater and wider than just investment management. My particular expertise is inheritance tax planning. We can do protection, mortgages, general insurance, the whole host of financial planning aspects for our clients.
Aaron, thank you very much.
Thank you.
Thank you.